welcome. You're watching News 9. I am Shweta Kothari. We're looking at top stories from the world of business policy and economy that you should keep a watch out for on today. And here's a look at the headlines that we are tracking at this point in time. After announcing a 20% TCS or international credit card usage, government has faced pushback. It has come out with clarifications. We will discuss those clarifications and more on the show today. And SEBI has also proposed a uniform total expense ratio for mutual funds, which means that mutual funds are going to be more transparent regarding cost they charge to unit holders. Also on the show, Indigo on Thursday reported a profit of 919 crores, which was a record quarter for Indigo as air travel boomed. And Swiggy has also declared its results. It's turned profitable in the March quarter of financial year 2023. All those stories and more on this edition. With me is my colleague Karthik Malhotra as usual.
Hi,
Karthik, hello Karthik. A good day to you. We're starting out with what we seem and are looking at as clarifications coming in from Ministry of Finance after that late night notification wherein they introduced a 20% TCS on international credit card usage. A lot of pushback on Twitter, on Facebook, people asking what should we do? Should we stop traveling even for client meetings? Not just for leisure purposes, but also for work purposes, because all in all, every form of credit card usage will be charged, except for educational and medical purposes.
So one thing is clear, and that is what I think is apparent in the social media rancor also around this, that nobody's happy with this move, right? And a lot of corporate voices have come out, including the likes of Mohandas Pai, who are saying that if your end goal really was to try and track the spends that individuals are making outside, there's no reason to make it as high as 20%. The same can be done at 2% or any amount, any percentage which need not be as high as 20%. Simply because this 20% burden is directly on the spender, on the traveler. So I think some interesting clarifications that came out later yesterday were that number one, this move is being done to make credit card usage come at par with forex cards and debit cards as well. Right. So, of course, the 20% hike now becomes irrespective on whatever mode of payment you're using other than physical cash. So, it's applicable on debit cards, it's applicable on forex cards, it's applicable on credit cards as well. But the justification to get credit cards into LRS was given that now it becomes completely at par with other means of payments made abroad. Right. Another important facet that came out yesterday was that corporate travels on corporate cards or on business tours are actually going to be exempt from LRS. So the debate that was hot until late evening yesterday, when we were also talking about this on our show and after that, was that how does a seller in any other country distinguish between a card being swiped belonging to an individual or belonging to a company? So now, of course, there is going to be a lot of work to be done on the tech infrastructure to make this distinction clear. But the circular clarified yesterday that any corporate expense or any business tour is not under the remit of LRS.
Okay. So we are only talking about leisure travel?
We are talking about holidays, individuals traveling for leisure, for tourism, for family vacations, for meeting family, for anything else. So that, of course, is the, but just to sort of, for our audiences who are joining us today who perhaps missed this debate yesterday, this rule becomes applicable from the 1st of July. However, even present day, starting 16th May, a 0.5% up to 5% tax, TCS, tax collected on source is applicable not on credit cards, it's applicable on debit cards and forex cards. Now, from 1st July, the tax collected at source on any international travel goes up to 20%. And this is going to impact anybody who's taking a trip outside Indian shores from the 1st of July. A $10 bill is going to cost you $12, a $100 bill is going to cost you $120. This cost is, of course, a temporary cost because this additional 20% delta is collected by the bank, deposited into the coffers of the government. But eventually, when you reconcile your taxes at the end of the financial year and when you file your taxes, you either get an adjustment or a refund, as the case may be. Okay. So, for example, if you fall in the bracket of, let's say, 20 lakh rupees annual CTC, taxed at, let's say, 20%, which is the prevailing rate, that is exactly the rate applicable on credit cards as well. So your credit card outgo on, let's say, a 1 lakh rupees spend happens to be 20,000 rupees. When you reconcile your taxes for somebody who is in the 20% tax bracket earning 20 lakhs per annum, 4 lakh rupees being the outgo, this 20,000 gets adjusted and your tax outgo will be 3 lakh 80,000 additional tax outgo.
Okay. A couple of reasons mentioned in the FAQ that was sent out by the ministry yesterday. One, that is, this payment is not a final tax, which essentially alludes to what you were saying, that you can reconcile this tax. I have two qualms about this, and this is on the basis of what people as well.
I have many more than two, so I'm glad that you have only two.
I have two, and this is in line with what many people are saying online. Number one is that 20%
is too high.
Is a tad too high.
That's what Mohandas Pai alluded to exactly this. He said the same tracking, what is the government's reason to do this? Sorry, I'll come to your second point also. What is the government's real operational reason to get something like this moving? So, some data which the government has disclosed, Finance Ministry has disclosed, the details are still awaited, but a headline figure of $24 billion in FY23 have been remitted internationally. The Finance Ministry statement states that 50% of this is on foreign travel, right? So that's a sizable $12 billion. I think the government is very interested to know where this money is being spent. I think the hunch that the government is working on, I could be wrong, I don't know, this is my reading between the lines, but my hunch is that the government assumes that a lot of spends are happening internationally exceeding the LRS threshold of $250,000 permitted by the RBI per annum. So the assumption could be that people are investing in property, but while they are investing in property, some additional component related to that property is being swiped on a credit card. So once these granular details of credit card usage become available to the government, it is able to track through that, draw some inferences on what other spends are being incurred by a particular taxpayer or tax evader, as the case may be, internationally, which is otherwise difficult to track for the government. But
fact,
it can be done at 2%, it can be done at 0.5%, it can be done at 1%, it can be done at any value, and 20% is bound to hurt people like you and me.
And you are absolutely correct. You're bang on, because the notification says that instances have come to notice where LRS payments are disproportionately high when compared to disclosed incomes.
That's right.
Essentially, you are trying to find tax evaders.
That's right.
Through this information. And if that was the sole purpose, then 20% could have been a 5% or a 10%, and you would still identify who the tax evaders are.
Okay, as long as, as long as this is targeted to HNIs only, right? 20%.
But you're assuming that only HNIs go abroad.
That's a wrong assumption.
Absolutely.
I mean, you could have HNIs living in 5 stars, traveling business class, but people like you and me, when we travel cattle class. We look for budget deals. We travel on a shoestring budget. And what this is also likely to do, and in fact, I read a statement of one of the tax partners at EY also this morning, it's going to compel people, hopefully not us, but a lot of people looking for cash deals on dollar exchanges.
That is true.
So with demonetization, with this entire, ease of payments within the country, internationally, with internationalization of UPI, with international credit cards available easily through banks which do your KYC, there was no reason for affluent travelers to really go and convert cash and look for forex deals in these little fly-by-night sort of operators sitting in nooks and corners of markets. You would get your basic dollars from your bank and you would carry your plastic. It was as simple as that. Today, people will be, you constrain the limit of somebody's expenses. If you have a budget of 1 lakh, you incidentally have to now cut down that budget to 83,000 rupees because 20% goes straight to the government.
Absolutely.
So people will look for steal deals and people will look at ways to evade this, which is not going to be healthy for the country.
And I think one of the ramifications of this, as you rightly pointed out, is that people will take to having more cash in hand, and that in itself results in a lot of problems on ground. Carrying more cash anyway, not encouraged by the government. So you're going against your very basic principle of what you've been discouraging locally, domestically. You're hoping that people going abroad will carry more cash, and resultant fears of cash loss, theft, etc. come with it.
And where is that currency exchange happening? Again, it's not happening through the banking channels. people who have surplus cash, see, why are you doing this? Let's come back to the basics. You're doing this to catch the tax evaders. Tax evaders traveling abroad, swiping credit card, you want to go after them. That being the basic sort of foundation of, presumed foundation of why this is being done. The same guys will have cash available in their local currency in India, will now go to a local forex exchange house, exchange it for dollars, make the same payments in dollars. So we still continue to suffer, right?
Absolutely.
You had a second concern also.
Not doing any good. My second concern, and this also alluded to the fact that, you know, firstly on the side of we as individuals ending up paying way more than what we were paying up until now if we are transacting. Another concern was with respect to what government is hoping to do with this, which is to keep the money with them. And this is again, it comes back from what they have written in that FAQ. And they say that if TCS is a taxpayer or TCS Pay is a taxpayer, he can claim credit for the TCS, as we were discussing, against the regular income and adjust it against whatever advance tax you've paid. So essentially you can claim it back.
Correct.
But after a year, which means government keeps that money interest-free loan.
Absolutely.
And that is another major concern, because if you wanted that money, there were other ways of getting that money as opposed to, you know.
Well, actually not too many other ways, because, you know, you can only get it by way of advance tax or eventual tax filing that, that citizens, tax-paying citizens or corporate houses do. So, yeah,
so this
you're
actually
right.
masks the
so
intentions.
You've amassed 20% of presumably $12 billion of outgo expected if the travel rate remains the same. Of course, you know, last year we also saw higher travel because of the post-pandemic sort of, you know, this whole you live your life only once, YOLO sort of a thing, and people went on an outrage and traveled. And this was
the
also sort of revenge, pent-up
COVID.
demand, revenge travel, revenge holidays. So that went up, but let's assume it continues to be the same. So you're actually getting a good 20% of $12 billion as advance tax, interest-free, you know, lying
you know, and this also comes on the back of the fact that I was talking to a travel agent yesterday, and he said in as many words that half the people traveling abroad don't even know that they're paying this TCS, which means that they will never claim it back. So this money will stay with the government, because not every person is aware about claiming their, you know, filing their taxes, claiming back the money.
So I think all the tax that gets collected at source here, because your credit card willy-nilly is linked to a bank account, in the statement, the AS26, form AS26 that gets generated every quarter, these transactions automatically appear there. So actual reconciliation will not be very difficult. You will not need physical bills.
But that is for people who are aware of the fact that they are paying as much.
Anybody who is filing taxes on the income tax portal and using bank statements as an indicator of how much tax has been paid, and therefore calculating how much is balanced, these numbers should reflect automatically. Anybody filing tax through a chartered accountant will also, you know, the CA will very easily be able to decipher this. So I don't think there's going to be a challenge of claiming this money back or adjusting this money back with or without awareness, because it's pretty much like interest you get on fixed deposits. It is taxable, it appears in your form AS6. Or, you know, any other sundry source of income that came that had a tax deducted at source, it gets reflected in your form AS6. This becomes one more figure or 100 more figures number of times you swipe your credit card in the form AS26AS, and that gets sort of, you know, readjusted, recalibrated. Should not be a problem. So one thing to note, of course, is that, again, for the purpose of our audience, if you have, you know, a child studying abroad or somebody who receives medical attention or medical care internationally, while it fits under the ambit of tax collection at source, the rate of 20% is not applicable, and it doesn't even sort of, you know, so there are two clauses here. If you've taken an education loan or a medical loan, then the tax collected at source is at 0.5%. Not 20% as is the case with credit cards, it's at 0.5%. However, if you have not taken the loan and the money being spent internationally on education or medical expenses is out of your own savings, out of your own money, then there's a 5% TCS. These two also have a limit, a threshold of 7 lakh rupees per annum. So anything over and above that 7 lakh rupees directly comes under the ambit of LRS and will be taxed at 20%.
That is correct, and those are very important Figures, very important information for all those who are hoping to, take a trip abroad in the month of July, because remember, it's not just your credit card spend that will now be taxed at 20%, also your foreign trips and tours starting July. So it's going to get more and more expensive for those who are planning a leisure travel in the month of July. So the time to travel, therefore, is in the month of June.
But the hitch there is flight tickets are already expensive.
Already expensive. So there you have it. Government making it difficult for you to travel. Perhaps take to traveling within India. That's also another motive that is being attested to this move.
So heads you lose, tails the government wins.
All right, we're going to move on now. Indigo reported a profit of 912.2 crore, a record for the month of March quarter. As air travel boomed, Karthik, Indigo there, a glimmer of hope in what we are looking at as a sector that is struggling to sort of carry its burden on its feet. It is literally dragging its feet at the moment. Indigo there, is a testimony to the fact that a planned airline, a well-managed airline can still be profitable. Contrary
to popular belief, right? I think airlines have been such a downer across the world, not just in India. And in India also we've seen, of course, starting with the good old or not so good old days of Sahara, followed by Kingfisher, followed by Air Deccan, followed by Jet Airways getting grounded in 2019, and finally Go First, which may resume operations, may not resume operations 26th, 27th May. That is still under discussion. But yeah, Indigo has been, the flag bearer of the Indian aviation, so to speak. And I think credit goes, of course, to the management, and credit goes to the efficiency with which the airline has continued to sort of, keep its operations up in the air. And let's look at the numbers, which have come out. So there's a 78% jump on revenue, and this is for the quarter of March. 78%, of course, look at it in context. 78 seems like a huge headline number, but 78% against the quarter of Jan to March 2022. Now, jog your memory back and remember, this is when Omicron was at its peak. So just before the Jan to March quarter, Q4 of last year, when institutions, movie halls, malls, air travel had just about resumed operations, while it continued to stay operational even during Omicron, the fear of another COVID wave, Omicron wave, had begun to sort of, play on the minds of people. So Y on Y, it's a great quarterly upsurge of 78%, but even in absolute terms, 14,600 crores in a single quarter is huge, and this comes on account of average daily passengers of 4,20,000. That's the number of people flying across the 300 odd aircraft that Indigo operates on a daily basis, and the profits that follow after tax of about 919.2 crores is obvious. I think Indigo is likely to have a much better Q1.
That is correct. I was about to come to that. Yes.
Than Q4 of the last fiscal.
With Go First going under,
that's right,
it's an opportunity window for Indigo.
So Go First, commanding a 7.8% market share, if I'm not mistaken, went off. Indigo was already in excess of 50, 54%, 56%, thereabouts. So, I mean, that 7%, 8% of Go Air will sort of, get diverted to other airlines as well, Vistara, Air India, Combine and SpiceJet, etc. But I believe that
as
Indigo,
a preferred low-cost domestic carrier,
so I think Indigo is likely to rake in a lion's chunk of that share just by the overall distribution of the pie, right? So now if a chunk of the market opens up, it should get divided in the same ratio across the other three remaining players. So Indigo should get a sizable upside of Go First not having flown all of May, which is the second month of this quarter. And in addition to that, you've also got increased airfares, which come again on account of course, aviation fuel, etc. being one, but also in general, air tickets have gone up owing to inflation, aviation fuel costs, and one airline off the skies. So sort of, an opportunity for the others to jack up their prices. Simple demand supply.
And correct me if I'm wrong, the first quarter of this year, which is the last quarter of financial year 23, is also a time where not a lot of people travel. This is when you're coming out of your winter months, setting into your March, and then it's usually that the air traffic goes up during the months of June, July, which
That's
is
right.
the months of travel.
That's right.
Which means that it's only going to get better from here on for Indigo if it sustain these numbers.
Right. So, I've been made to understand by some aviation watchers that a good 60 to 70% air traffic, passenger traffic on aircraft in weekdays, Monday to Friday, are actually business travelers. So while the holiday season is great for family vacations, and that is when you see more traffic to destinations like Goa, destinations like, hill stations where flights operate, or northeast where people are actually going, where the frequency of flights is not as high as, let's say, Delhi, Bombay, Delhi, Bangalore, Delhi, Hyderabad kind of a sector. But Monday to Friday, the bulk of the air passengers are flying for business, and that activity sort of continues throughout the year, except for end December holiday season when it comes down, and some lean months of June, July, where a lot of people continue to sort of, spend time with family and are on vacation. But otherwise, year long, the traffic really comes from corporate flyers. And that is why maybe, you see the surge as well, that higher air fares are not really impacting travel much. Had it been personal travelers traveling on holiday, leisure activities, you would have seen some correction in the number of passengers taking to the skies. The sort of chaos at airports and the number of people in queues at airports would have been reduced. But as long as it's being paid for by a company for corporate travel, so anyway, coming back to the Indigo story, I think this quarter is going to be even better than the last quarter that
Absolutely.
it has seen.
The expectation is that the quarter is going to be even better. But, just to sum it up, this comes amid the fact that one of the major domestic aviation players in the country has gone under, owing to various reasons, most prominent being what it said was its financial problems owing to its engine.
That's right.
Now, we also know that of the 300 strong fleet that Indigo has, many of them, and I don't have the exact number here, I actually do have exact number, 23 are A320
Airbus A320
Neos,
which have the same Pratt and Whitney
which have the
engines.
same Pratt and Whitney engines. And so the concern, of course, being, and although Pratt and Whitney and Indigo seem to have a very solid partnership, they're not facing the same problems that Pratt and Whitney and Go First are facing at the moment. But it's sort of aviation sector at large in the past couple of weeks has been a bummer. There have been a lot of negative news coming in from aviation sector with respect to SpiceJet, Go First. And so with Indigo now, the responsibility for Indigo's management is even higher, to meet the demand, the growing, surging demand post-COVID in India.
Sure. And I think, again, the demand-supply equilibrium gets met at a certain price. So where demand and supply curves intersect, that is the price point. So I think in a short period of time, there is precious nothing you can do to increase supply, right? Getting new aircraft, getting more number of seats to be taken to the sky is a long-term plan, and that is a reflection of what kind of an order book you have placed with Boeing or Airbus, as the case may be. When are those aircraft expected to arrive? Do you have enough parking space, infrastructure to house those aircraft, maintain those aircraft, etc.? But I think price is going to be the real volatile piece in the graph. As demand goes up and supply is limited, the equilibrium will be met at a higher price. So I think the responsibility that Indigo owes, and any other airline or any other business owes, is only to its investors, and maximizing shareholder wealth is the prime reason for any business to stay in existence. And I think that's all Indigo or any other company owes to its investors, and nothing over and above that.
It's a sigh of relief as well, I think, for every aviation watcher at this point in time.
True.
I'm going to move on now. Swiggy has declared that its food delivery business has finally turned profitable in the March quarter of financial year 2023. And this is good news because Swiggy hasn't reported profit so far. So it's broken even, and we finally know of a food delivery aggregator that is profitable. Comes on the back of what we've been hearing as disrupting news when ONDC entered the market. But all in all, looks like profits are in the books.
Right. So, ONDC is, while it's been in talk since September, October last year, its real introduction in the formal food delivery ecosystem is just about 2 weeks old or so, maybe a month or so, right? So what we're talking about, Swiggy's profitability is again Q4 of last year. So I think the ONDC impact had not really come in by then. But there is a lot to actually discuss about this story, and I don't know if I can request Hamad and Shalini to pull up the graphics here on the screen, and let's look at what we are really talking about here. We are talking about a startup which was a prime unicorn. Unicorn is a $1 billion company. Swiggy had actually broken into the Decacorn club, right? $10 billion in valuation. It's not a Decacorn right now, but if you look at these numbers, it's taken Swiggy 9 years to turn profitable. In traditional brick and mortar companies, you can't sustain a business for 9 years without making money. So it's investors' sustained investment and sustaining those losses on their books and staying invested in a vision that the founders had. That sort of has kept the company afloat, and it's been growing, of course, in revenue, in users, in average ticket size, in return users, but profits have come a good 9 years later, right? Now, Swiggy apparently has also stated in a blog that the founder, Mr. Majeti, had written yesterday that Instamart, which is its quick commerce segment, is only 3 years old, but that is also going to turn profitable in a few weeks. So what it tells you is that as a whole, it's taken 9 years for the food delivery business to turn profitable, but it has taken only 3 years, or just about 3 years, for the quick commerce segment to break even. If not profitable, it'll break even, right? So that is good news, that as you get scale and as you become a bigger consolidated entity, you start eating into your operational efficiencies across departments, and learnings get passed on from one business unit to another, and the path to profitability gets accelerated in such an environment. The next important figure is that last year, FY22, Swiggy had a loss of almost 3,628 crore rupees. This is a big number, and this number actually doubled from FY21, which was at about 1,600 crores.
Okay.
So the graph having moved from a minus 3.6 thousand crores for the financial year to a quarterly profit is sizable, right? So this speaks about a very affluent ecosystem where people are ordering more consistently, are paying the higher delivery fees, are paying the higher rider fees, and are really using these services more than they used to a year, 2 years ago. 2021 losses are understandable, COVID, Delta wave, right? 22, it doubling for the financial year, big number. And now from that number to really go into the green is actually quite impressive. Now, if you remember, Swiggy had also laid off, sorry, I think the number is 380, my typo there, not 280. There were 380 employees that were laid off earlier this year, right? So I think the pressure to turn profitable has been there on Swiggy for a while. Now, two important things. I mentioned Decacorn earlier, right? Decacorn is a $10 billion startup. Now, it has turned profitable, but the profitability coincides with the Decacorn status also being lost. So if you remember, Invesco has downgraded Swiggy's valuation from $10.1 or $10.7 billion to about $5.5 billion. They say 5.4 to 5.6. Invesco has halved its valuation on Swiggy. Coincidentally, Baron Capital has reduced it, but reduced it only about 30-35% to $7.1 billion. So I think this entire story rakes up a whole new debate on how are startups really valued, and the inverse relationship between profitability and valuation. One would logically like to believe that as the company becomes more profitable, its valuation should be seen at a higher level. But here, the dichotomy is that it turns profitable at a time when its valuation is reduced by 50% in one instance and 30% by another company. So what is the metrics of valuation?
And so the larger debate around valuation, where we play up valuation on big screens, we are self-impressed.
We celebrate 115 unicorns, 10 decacorns,
yes,
and whatever.
And we take a lot of pride in the fact that we have so many unicorns and decacorns. At the same time, some of these organizations dwindling to make profits, and Swiggy here, great example of why you don't have to be a decacorn but you have to be profitable because end goal is profitability.
Absolutely. So end goal should logically be profitability, but like I just mentioned in the case of Indigo as well, fundamental business requirement or the purpose of being in business is return of shareholder value. So as long as you're able to keep your investors in the green, no matter what your books say, I think you are in an okay position. As long as one investor invests in a business, ends up making some money on his exit or by way of additional capital infusion, as long as anybody who's an investor, whether a retail investor or an institutional investor, is making money by being invested in that business, that of course, is serving the purpose of the business being in existence. But the dichotomy of profitability coming and valuation reducing is of great intrigue, and one needs to sort of study this and see how the math of valuation really works and why this inverse relationship between profitability and valuation.
And one can't let go of a discussion around food aggregator services without talking about the freebies that they have to offer. I'm not sure if you are subscribed to Swiggy One. I know many of my colleagues are, and they talk about savings in huge number, but freebies there, sort of have reduced in the past couple of weeks and months, and that could be one of the reasons why Swiggy has turned profitable.
You're right.
Because there's no free lunch.
You're right.
And you cannot sustain in the business by offering huge discounts. So what we have witnessed, in fact, and I'll bring in the discussion around ONDC in once again, is that sometimes the food menus are inflated and then there is a discount, but net there is some profit that Swiggy or Zomato, its rival, is able to book at the end of each transaction. But I think all these aggregators have now realized that they cannot continue offering freebies, discounts in the long run.
Absolutely, Shweta. And I think you're right, and the observation is bang on. But these freebies, as we see them, are actually a marketing expense for the company, right? So what do you do by way of giving, let's say, a 50 rupee discount or a 10% discount, or or any other scheme, a coupon code which permits you to get a bumper 150 rupees off on a particular order? What are these? These are actually marketing expenses for the company. So it's booked under the P&L, of course, but on the marketing side and not really on the per delivery cost. So that is to broadly understand the books. But what are you spending this money for? You're spending this money on customer acquisition. You could offset this discount by releasing, let's say, full-page newspaper ads. You could offset this cost by releasing television commercials, right? This is marketing money that a company has to spend irrespective in acquiring customers. It's a new form of attracting customers and increasing your customer base. So you make the customer feel empowered that, hey, I'm not spending money on a communication creative which may or may not reach you. I'm rather offsetting that expense straight on your bill, and I'm acquiring you, right? So multiple ways, and yeah, I am a Swiggy One customer. I'm also a Zomato Gold customer, and I'm also a Paytm on ONDC subscriber. So I mean, it tells you how much food I order or like to order. But yeah, I think so. The schemes that they usually toy with are new restaurant. They give you a scheme, right? You return to a restaurant after a long time, they give you a welcome back, right? But once the algorithm understands that you are a regular avid foodie
from that particular place,
and there are certain preferences that you have where you order regularly from, they don't give you any discount.
Absolutely.
Then the discounts they give you are on credit cards. Hey, take this Access card, credit card, or take this ICICI credit card or any other, and then so that these are again bank tie-ups, partnerships that they do. But with ONDC, of course,
I want to bring in a conversation around ONDC.
So what is your view on ONDC? Do you think it's actually going to be a disruptor?
Well, to my mind, instantly there has been some sort of uptick. A lot of people are very curious, especially in Bengaluru, not so much in Noida, because there are not a lot of restaurants which are currently on ONDC in Noida. But in Delhi, there are a few. Some of my colleagues here at News 9 have tried ordering, and they managed to order, booking some sort of profit, as in not paying more, paying less, relatively lesser, and that is leading to a word of mouth that is spreading very, very quickly amongst people who uses these apps on a daily basis. And my understanding is, if ONDC tries to run its operations in the way Swiggy or Zomato do, or tries to onboard many customers, goes hunky-dory on trying to onboard as many businesses around them, trying to reach out to these businesses, actively getting people on board, then not in the long run, but in the not in the short run, I beg your pardon, but in the long run, 8 months, 9 months, 10 months, I could see, I do see them disrupting Swiggy and Zomato's business. I do see them, having some sort of impact on the bottom line as ONDC starts acquiring more customers. Because let's not forget, most of us who buy online or who are ordering food online know what our preferred choices are. We're buying it from a restaurant, either one that we've visited before, or we know where we should be buying our food from every weekend. So in most cases, the restaurant and us as customers already have that partnership, and ONDC is helping you directly reach out to them. The restaurant is reaching out directly to you, and you reaching out directly to the restaurant. So sort of bringing you both closer together, acting only as an intermediary, acting only as a handshake, as opposed to acting as a barrier between the two, and that is going to have an impact on Swiggy and Zomato's bottom line. Now, I'm not saying that just out of my own assessment of it. We also saw how Zomato took a beating, the stock of Zomato took a beating immediately after ONDC and the news around ONDC was announced, so much so that they had to come on record and say, we are fine, we are here, and we are not looking at our any sort of bump in our operations. So we are actively still acquiring customers, and our operations and our profits haven't really turned negative. So don't go by what you are listening, because there's such a hullabaloo and such a loud noise around ONDC in the past couple of weeks. It's faded a little bit. I'm not sure why that is, but one needs to understand that ONDC has to operate from a place where private entities operate, that is, be very aggressive in acquiring more sellers, more restaurants, onboarding more services. Because you remember, we spoke to Chief Business Officer of ONDC, and he said that it's not just about food services. You'll soon have medical services. You'll be able to book a cab. So we're looking at one app doing it all. Something that, that's been sort of a dream for a lot of people who have 20 or 30 apps, from booking a cab to ordering food to medical services. Net, so many apps. If all of that could just, combine together and give us just one app where we can do it all, I think everybody's going to prefer that.
Great, excellent insights, Shweta. I just have 2, maybe 3 concerns, right? If let me take them one by one. Number one, we understand ONDC is backed by the government. It's plug and play e-commerce, and profitability is not the core reason for ONDC's existence. However, to sustain ONDC, losses will also not cut it. So my point is, ONDC will also only have deep enough pockets to sustain these discounts which are being offered either by restaurants or ONDC directly, or the aggregators like Paytm or Magic Pin, as the case may be, only to a limited point. So customer acquisition, which again, the marketing cost around acquiring customers, would be offset only to a point, and beyond which these irrational deep discounting will have to cease to exist, right? So this is my first sort of contention with ONDC being a game changer disruptor. Yes, it will enable a lot of other small restaurants to ride on ONDC without paying the 15%, 20% commission that they pay Swiggy or Zomato. But the second point, and I'm leading to that, the second point is that I doubt well-funded, deep-pocketed, now profitable Swiggy and Zomato will not be caught napping. So I think market forces will get them to reinvent and figure out ways of keeping their customers with them. This could be through extended loyalty programs. These could be through other bundling of of other goods and services. This could be whatever. They've got very smart marketing teams. They've got excellent consultants on board, and they've got venture capitalists with insane experience in investing and keeping startups in India and internationally afloat and maybe profitable. So they will come out with great counter theories and
one of the big
practices.
counters, and I think I have to say this, from the point of someone who's been tracking this, and all of us have been talking about this for a while, one of the way to do this would be to plug into the fear that we keep your data safe, which is what ONDC is not promising.
Yeah, so ONDC is saying, I am not transmitting your critical details back to the to the restaurant. But anyway, so yeah, you're right on data security as well. But I think that to explain to an Indian audience is going to be a little, little difficult because we are not very data savvy
That
yet.
is correct.
So the point is, these guys, Swiggy, Zomato and the likes are also going to reinvent. And if they face a serious threat from an ONDC driven supply chain, they will reduce their commissions. They also need to stay in the game, right? So they will make more incentives for suppliers, restaurant operators to continue being with them for the service that they provide, right? The third thing I want to elucidate through an example, and I'll do it quickly, I know we are almost out of time. Yesterday, through one of the quick commerce websites, I'll not name it, through one of the quick commerce websites, you ordered a lot of stuff, including a loaf of white bread, along with some cans of some beverages. Now the bread actually came broken into half because when it was packed, the cans were stacked up on top of the bread. So there were slices of the bread broken and the entire shape of the bread loaf was a nice beautiful U shape. So I was actually confused. Did we order a pretzel or did we order a bread? But anyway, it was a white bread. So it came broken. It took me perhaps 2 minutes clicking a picture of that bread, uploading it back on the quick commerce platform, few message exchanges with a chatbot stroke human being. I don't know, it was pretty good. So it was hard to decipher. One phone call, do you want your money credited back into your wallet linked with that quick commerce app or to the source of payment? My source of payment was UPI. I said source of payment. Within 5 minutes from the time I raised the complaint, I had my 50 rupees on that broken bread back and I got to keep the bread as well. Right. Now, in such a beautiful customer experience scenario, can individual sellers, individual restaurants or individual operators who will use third-party delivery vehicles, will they be able to offer the same customer experience? Because for me, for an urban Indian who values time and convenience over most other things, one of the prime reasons why we really go after these quick commerce applications is for the time and convenience, right? So if that customer experience is not lived up to, I'm not jumping gun to an ONDC platform.
Not jumping ship, rather.
Not jumping ship, sorry, to an ONDC platform.
Not jumping. Karthik is not jumping ship, but I think all in all, the discussion boils around how easy and convenient it is to order food through one of these quick delivery services app as opposed to ONDC, which is just foraying into the market. You know that you're going to be directly talking and transacting with the restaurant, which may not be able to offer you same sort of services and will not be making your life easy in case you want to exchange, you want to give it back, it's not the quality, the taste is not good enough. So all of those, of course, will remain prime concerns. We run out of time, Karthik, but interesting story there coming in from Swiggy at this point in time, which has finally turned profitable after 9 years in operation. We will continue to track all those stories and more. Keep watching Newsline.